Hey, what's up everybody, it's R. Are you ready to start investing in stocks but don't know where to begin? You're in the right place. In this video, I'll guide you step by step on how beginners can start investing in the stock market with confidence. We're going to cover everything from understanding how the stock market works, to choosing the right accounts, picking your first investments, and even avoiding common mistakes. Whether you want to build long-term wealth, save for retirement, or just grow your money safely, this guide is for you. Investing can seem intimidating at first, but trust me, it doesn't have to be. By the end of this video, you'll have the knowledge and confidence to start investing today. So, let's get started. Alright, before we dive into the exciting world of investing, let's break down what the stock market actually is. When you buy a stock, you're buying a tiny piece of ownership in a real company. Companies like Apple, Tesla, or even your favorite coffee shop issue stock to raise money. They take that money and invest it back into the business, maybe to develop new products or expand into new markets. As the company grows and becomes more profitable, the value of its stock typically goes up. There are two main ways you can make money from stocks: capital gains and dividends. Capital gains are when you buy low and sell high. Dividends are regular payments from the company's profits. Of course, the stock market isn't without its risks. Stock prices can go down as well as up, so it's essential to do your research and invest for the long term. Now that we've covered the basics of the stock market, let's talk about you. Before you even think about buying your first stock, we need to define your why. Are you aiming for long-term wealth building, retirement savings, or generating passive income? Once you have a clear understanding of your investment goals, you need to figure out your risk tolerance. If you can stomach market ups and downs, growth stocks might be for you. If you prefer stability, dividend-paying stocks or index funds might be better. Remember, there's no right or wrong answer here. It all depends on your personal financial situation, your goals, and your risk appetite. Alright, so you're fired up about investing, you've got your goals set, you know your risk tolerance. Now, where do you actually buy and sell these stocks? That's where brokerage accounts come in. Think of a brokerage account like your gateway to the stock market. It's like a specialized bank account that allows you to buy, sell, and hold stocks, ETFs, bonds, and other investments. The most common one is the traditional brokerage account, offering the most flexibility. Then you have retirement accounts like the 401k or the Roth IRA, designed specifically for retirement savings with tax advantages. For beginners in the US, here are a few popular brokers. Robinhood for its user-friendly interface and commission-free trades, Fidelity for a well-established reputation, and Charles Schwab for excellent research tools and customer service. Choose the one that best fits your needs and complete their online application process. Once your account is open and approved, it's time to deposit some money and start investing. Okay, now comes the exciting part: choosing your first investment. But with so many options out there, it can feel overwhelming. Don't worry, we'll break it down. You've got three main choices: individual stocks, ETFs, and mutual funds. Individual stocks offer the potential for high returns but come with higher risk. If you're just starting out, consider ETFs or exchange-traded funds. ETFs are like baskets of stocks that track a specific index, sector, or theme. For example, instead of buying just Apple stock, you could buy an ETF that tracks the entire tech sector. Mutual funds are similar to ETFs but are actively managed by professional fund managers, typically with higher fees. For beginners, S&P 500 index funds or total stock market ETFs are great options for broad diversification. Some popular S&P 500 ETFs include SPY, VOO, and IVV. Total stock market ETFs like VTI or ITOT are also excellent choices. These funds aim to track the performance of the entire US stock market, giving you even broader diversification. Before you hit that buy button, it's crucial to do your due diligence and research the companies or ETFs you're considering investing in. Investing without research is like throwing darts blindfolded. You're just hoping for the best. Look for company growth, consistent upward trends in revenue and profits. Check out the PE ratio, or price-to-earnings ratio, to see how much investors are willing to pay for every dollar of a company's earnings. If you're interested in passive income, pay attention to dividend yield. Luckily, we live in an age where tons of free resources are available to help you research stocks. Websites like Yahoo Finance and Google Finance provide a wealth of information, including financial statements, historical data, and analyst ratings. There are also stock market news apps and websites that can keep you up to date on market trends, company news, and expert analysis. Some of my favorites include Bloomberg, Wall Street Journal, and Seeking Alpha. Remember, knowledge is power, and the more you know about your investments, the better equipped you'll be to make informed decisions. Alright, we've covered a lot of ground, and now you're ready to start building your investment portfolio. But with so many different investment strategies out there, it's easy to get overwhelmed. Don't worry, we'll keep it simple and focus on a few beginner-friendly strategies that have stood the test of time. One of the most effective and easiest strategies to implement is dollar cost averaging, or DCA. This strategy involves investing a fixed amount of money at regular intervals, regardless of the market conditions. The beauty of dollar cost averaging is that it takes the emotion out of investing. Another popular strategy, especially for long-term investors, is buy and hold. This involves investing in high-quality companies with strong fundamentals and holding on to those investments for years, if not decades. If you're looking for passive income, dividend investing might be a good fit for you. By building a portfolio of dividend-paying stocks, you can create a stream of passive income that can supplement your regular income or help you reach your financial goals faster. Even with the best intentions, it's easy to make mistakes when starting out in the stock market. I'm here to warn you about common pitfalls to avoid and protect your money. One big mistake is investing without research. Never invest based on hot tips. Another trap is trying to time the market. Focus on time in the market, not timing it. Diversify your investments. Don't put all your eggs in one basket. Spread investments across different asset classes. Never invest money you need short-term. Invest with money you can let grow for years. Ready to buy your first stock or ETF? Let's break it down. First, open a brokerage account. Choose one that fits your needs and complete the application. Deposit money into your account. Search for the stock or ETF you want to buy. Enter the ticker symbol and decide your investment amount. Review your order and click buy. Congratulations, you're an investor. Congratulations, you're now the proud owner of stocks or ETFs. But your investing journey doesn't stop there. It's important to regularly monitor your investments and make adjustments as needed. Now, you might be tempted to check your portfolio every day, especially when the market is volatile. But resist the urge. Constantly checking your portfolio can lead to emotional decision-making and potentially harm your long-term returns. Instead, aim to review your investments on a monthly or quarterly basis. This gives you a chance to track your progress, see how your investments are performing, and make any necessary adjustments to your portfolio. Over time, some of your investments may grow faster than others, which can throw your portfolio out of balance. Rebalancing involves selling some of your winners and reinvesting the proceeds into your underperforming assets to bring your portfolio back to your desired asset allocation. This helps you manage risk and stay on track with your investment goals. Remember, investing is a marathon, not a sprint. Stay the course, stick to your investment plan, and don't let emotions dictate your decisions. Congratulations, you've reached the end of this beginner's guide to investing in the stock market. You've learned the fundamentals of investing, explored different investment options, and discovered strategies for success. Remember, the key to successful investing is to start early, invest consistently, and stay disciplined. Don't be afraid to make mistakes along the way. That's how we learn and grow. Continue to educate yourself about investing. Read books, listen to podcasts, follow reputable financial websites and blogs. Consider your risk tolerance and investment goals, and start building a diversified portfolio that aligns with those factors. Don't be afraid to seek professional advice from a financial advisor. Remember, investing is a journey, not a destination. Enjoy the ride, stay informed, and never stop learning. Congratulations, you now have a solid foundation for investing in stocks. The key to success is patience, research, and consistency. If you found this guide helpful, make sure to like, subscribe, and hit the notification bell for more financial tips. I'm really glad you joined me on this journey to demystify the world of investing. Remember, you don't need to be a financial expert to start growing your wealth. With the right knowledge and a little bit of effort, anyone can become a successful investor. Comment below with any questions. We're here to help. Until next time, keep learning, keep growing, and I'll see you in the next video.